Hello and welcome back to my channel. I am Christy Vann with Fantastic Finances, and on this channel I teach velocity banking. So today I'm going to get a little bit serious because I had a client come to me wanting to refinance their home. They asked me what I thought about it, and the first thought I had was, No! What are you thinking? Let's talk about why you don't want to refinance. Let's talk about why a line of credit would be so much better for your situation. Let's talk about why you are getting robbed and you're allowing it to happen month after month after month. This couple has an income of $8,300 a month. Their current expenses are $7,671 a month, and they have a cash flow of $629. They want to refinance their home because they want to get rid of some of their debt. So let's talk about why they should use a line of credit to get rid of this debt instead of a refi. You know, the fabulous words that the banks hit us with when we've had our home about 4, maybe 5 years, because they want to refinance all that interest you've already paid. Let's see exactly what they get us for when they do this, okay? So the origination cost on this mortgage is going to cost them $10,875. That's just the origination fee. Then they're going to pay $5,239 in extra fees, you know, like appraisal fees, document fees, title search fees, etc. So their total closing cost is going to be $16,114. $16,114 just for processing the mortgage. Now let's talk about the debt they want to get rid of. So these are the debts that they're wanting this new mortgage to wipe out for them. A credit card, another credit card, another credit card, a car loan, and then the bank's going to give them $31,375 just because they've been really good kids and making their payments on time. So the total that they're going to be paying off plus their play money is going to be $92,504. So the loan amount of this mortgage is going to be $320,000 at 6.375%. That also includes the credit card payments and the car that they're going to be paying off. So the original totaling all of these together currently are $3,283. So with the original payments being at $3,283 and the new payment at $2,581, that means that they will save $702 a month because they're getting rid of this debt. So when you add up the credit card payments and the car payment, you come to $1,320 of cash flow they've gained by paying off these debts. They already had $629 in cash flow, remember? So you add those two together and they have $1,949 a month in cash flow now. Is that thanks to the refinance? So just so you know I'm not making up these numbers, I wanted to show you the original mortgage documents that this couple is supposed to sign on the 21st day of this month. So if you notice, the loan amount is $320,000 at a 6.375% interest rate. So the monthly payment on the principal and interest is the $1,996 that you see here. Down here includes what their actual payment will be because the escrow is included. So you're at $2,581. If you look on down here, you see that the closing costs are the actual $16,114 that I showed you on the board. Okay, so now let's go on down here to the last page that shows us exactly what interest they are going to pay over the next 5 years. So in 5 years, you will have paid $133,447 in interest. $20,880 is all that went to your principal. Looky here though, your annual percentage rate, the APR, is 6.757%. What? So this 6.375% isn't the actual rate you're getting? That 6.757% includes some more fees that they add throughout the year. Let's keep looking. And when you all ask me questions like, when you take the mortgage rate, like the 6% here, times 2, that's 120. How do you get the times 2? Well, you get it right off of your mortgage documents. Let's look. So if you notice, the total interest percent is 124.787%. That's where we get the times 2, okay? So it's 6.375% here, right? Not hardly. Even your loan documents tell you, okay? So as you just saw in the loan documents, the interest on 60 months is going to be $133,447. Then the fees that they pay just for the origination and closing costs is going to be $16,114, with a total of $149,561 in charges for this mortgage in the 5-year period. But what if we were to get a line of credit? The same amount. Remember, they're getting $92,504 of their equity to pay off their credit cards, their car, and to give them some play money, remember? What if they went ahead and got their own line of credit, a HELOC for $100,000? They have plenty of equity to do that. They have excellent credit scores. As I showed you earlier, if they go through with this new mortgage, they're going to get $92,504 to use to pay off their credit cards, their car, and to give them a little bit of play money. Remember? The $31,375 in cash. So those totals came to $92,504. Their income is going to go into this line of credit. So $8,300 goes in, bringing that balance down to $84,204. Now remember, when we use a line of credit and that income goes in, it satisfies this payment. So there is no payment due on this line of credit because you have satisfied the payment when you did the income transfer. So also look here, this 1963 is their home. That's their mortgage payment. So I am including it. I get that question a lot. It's people will say, yeah, but you didn't include the mortgage payment. I do. I just add the expenses together, which you see down here at $63.51. That's the 1963 and the $43.88 for living expenses. So all of their monthly expenses are included in this, okay? So I charge 10% interest on this because that's kind of the going rate today in 2023. The banks figure interest on the average daily balance. So I took the numbers, averaged them out, times 10%. That gives you approximately $740. I'm a little bit high here. I like to leave room for error. So in the second month, they're going to put in another income transfer, bringing that balance to $82,995. Here's the expenses coming out again, $63.51, and here's the interest at $730, bringing the balance to $90,076. In month 3, they'll put in their income again. Their expenses will come out, the interest will come out, and the balance will be at $88,847. Income goes in month 4. Balance is $80,547. The expenses and the interest come back out, and we're back up to $87,608. In month 5, $8,300 in income goes in, $63.51 in expenses comes out, and so does the interest at $700. The balance is at $86,359. So with all of that being said, what are the final results? Well, remember here on this new mortgage for 60 months, they would have paid $133,447 in interest alone. Then the fees, of course, at the origination of the loan brings the total within 5 years to $149,561 in just extra fees and interest, okay? So let's move over here to the line of credit. So when you figure the interest on the original mortgage that they had, it comes to $42,464. Now remember, they've been in this mortgage for 5 years, they've paid it down, and that is about the time that they come around and say, you've been such a good boy or girl, we'll give you $92,504 if you'll just refinance, and yeah, we're going to raise your payment, and yeah, we're going to charge you a bunch of interest, but you get $92,504, right? So when you continue to run the numbers, you're going to find that the total payoff on this LOC is going to be 61 months. So in 61 months, this line of credit will be completely paid off. So how did we do when it comes to comparison of the new mortgage and keeping the old mortgage but getting a HELOC or a line of credit to pay off the debts instead? So remember, with the new mortgage, they were going to pay $133,447 in interest, and don't forget the closing costs at $16,114, bringing the total to $149,561. Now, what happens if they go ahead and let this line of credit run out for 61 months and just keep their original mortgage as it is? Well, in 61 months, the Interest that would be paid on the original mortgage if left alone would be $42,464. Now remember, they've paid a lot of interest already on this home because they've had it almost 5 years under the original mortgage. Remember, as the line of credit comes down, so does that interest. So the total interest on the line of credit is going to be $24,400 over the whole 61-month period. That brings a total of $66,864 that was paid in total interest for the original mortgage and the new line of credit. So was any actually saved with the line of credit, or should we just have gone with the refi and forget it? Well, if the refi cost us $149,561 over a 60-month period, and keeping the old mortgage and getting a line of credit cost us $66,864. Well, who do you think won? It looks like to me, using the line of credit, we just saved $82,697 over a 5-year period. Now think about that. This couple, not doing anything different, but just putting their money where it serves them in a line of credit instead of doing another yucky mortgage, can put $82,697 in their pocket instead. $82,697 saved by just putting your money where it serves you. They didn't get a different job. They still got all the money they wanted. Remember, they were getting the play money for over $31,000. They were getting their debts paid off anyway. There's just a much cheaper way to do it without throwing away your hard-earned money. Do the numbers. It's just math. All of the numbers I showed you, you can do yourself with a calculator. I showed you the actual interest that the bank said they're charging. That was their loan documents. You saw it with your own eyes. I saw it with my own eyes. A line of credit is going to beat a mortgage most of the time. Of course, it depends on where you start. But is a refinance something that you really want to think about when you run those numbers and you see that getting a line of credit will accomplish the exact same thing you want done, paying off debt, giving you a little play money, all while saving you over $82,000. It's that simple. I hope that this made some kind of sense to you, because I want everyone to understand that you have to think about how you're spending your money. The banks are not thinking for you. You need to learn what lines of credit serve you and what loans don't. You can make so much difference in your own finances if you will just look at where you're putting your money. If you can get a mortgage, you can get a line of credit. Same credit scores. Same DTI. If you walk into a bank and they say, no, you can't get a line of credit, you have to start with this mortgage, you walk away and go to another bank. There are banks out there that are giving lines of credit. I'm seeing the results every single day, and I want you to be a winner. I want you to save your money. I want this money to go into your pocket. I'm not winning by telling you this. I want to see you win. I want to see you save hundreds of thousands of dollars. Don't pay anyone to tell you how much money you're losing. Figure it up yourself. Be excited to know your numbers, because when you know your numbers, you're in control. And when you make good decisions, like, am I going to refinance or am I going to get a line of credit? When you make good decisions, you put money back in your pocket. You don't have to get taken advantage of anymore. You know the truth now. And the truth will make you free. It will make you debt free. That's exactly where I want to see you. I appreciate you guys watching today. I hope this brought value to you. I hope I was clear enough so that you can understand how this works. I hope you guys have a terrific week, and I look forward to seeing you in the next video.